Be Wealthy and Smart, episode 1137.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 2022. Well, it turned out that 2022 was one of the worst years we have seen, certainly the worst since 2008, and it was the fourth worst year since the S&P 500 started its inception in 1957. The S&P 500 finished 2022 down 19.4%. The Dow was down 8.8%, and the NASDAQ fared the worst, with the tech stocks down 33.1%. This is highly unusual since the stock market generally goes up about 71% of the time. At least that's true for the S&P 500. And the interesting thing is I'm hearing more and more commentators on television talk about why 2023 will also be a negative year. They are so pessimistic, it's really quite shocking. It's unusual for the S&P to have two negative years in a row, but it has happened before. It happened back in 1973 and most recently in the year 2000. I was around and investing in the year 2000, and it felt nothing like 2022. Let me tell you what happened in 2000 when we had 2 years of negative returns after a 10% negative return in 2000. First of all, leading up to 2000, we had an incredible speculative bubble. We had an IPO market that was out of control. We had internet stocks going up over 100% a year. It was something like we've never seen before. The market peaked in March of 2000 and finished the year down 10%, followed in 2001 by another down year, and in 2002, it had a catastrophic final bottom of minus 23% that year. But the interesting thing that was different back then is that people were still incredibly bullish. In 2000, people were not expecting that to be the peak. And all of the media was telling us this was a new era, this was going to continue on forever, we were going to have unusual high returns for the rest of our lives because the internet was going to change everything. And we didn't have to have real profits, all we had to have were eyeballs and clicks. It sounds ridiculous now, but this is what the media was saying. So in 2001, when we had a negative return, we thought certainly 2002 we would have a positive year. But that was not to be. The hangover after Y2K, or the fear of computers not being able to calculate the right date, was so real that in 2000, just about every company bought all new computers and all new equipment and all new software and created a huge tech boom and bubble that coincided with the internet bubble. This meant that they were up to date on all of their tech needs and didn't need to buy any really for the next couple of years. So technology really didn't do well and earnings were pretty bad for the couple of years following the year 2000. People didn't really anticipate that that's what was going on, and they thought that these companies would have strong earnings, and even if there was one down year or maybe 2 down years, certainly things would turn around. But it was not to be, and we had 3 years in a row of negative returns. A highly unusual situation, but nonetheless, it happened. But it happened because people were extremely bullish. I mean, over the top, couldn't imagine the market not going up. It was a different time and a different era. What we have in 2022 was the Fed raising interest rates as a result of oil prices going up because of the Ukraine war and because of sanctions, and because of that, inflation going wildly rampant through the economy, and the Fed deciding to step in and raise interest rates to try and slow things down. They hiked and hiked and hiked interest rates. And then, even though inflation peaked 2 months ago and we've had lower rates of inflation since, now the Fed is focused on the strong job market and wants to see the job market weaken before they want to commit to not continuing to raise rates. This is somewhat of an outlier year, but we have seen this before, where the Fed got a little bit too aggressive and actually caused a recession. Then the Fed came back in and cut rates after raising rates too fast. We may see that again, or we may not. But the point I want to make today is to let you know that this has happened before. We've had catastrophic years before. We've had years of negative returns before. And we still have been able to achieve an 8% to a 10% average annual rate of return over the long term in the stock market. So catastrophic years are never fun, but I don't want you to lose confidence and think that you're not going to reach your financial goals, because you definitely still can in spite of this catastrophic year. In fact, the year after a down year in the S&P 500, the market has rebounded with positive performance 80% of the time. And the year after that negative performance, the average return has been a healthy 15%. So while I can't guarantee that in 2023 the market will go up 15%, we do have statistics on our side. We also had a healthy December. The S&P was up 7.1% in December, the Dow was up 15.4%, and NASDAQ lagged but was down only 1% in December. The comeback, as always, depends on corporate earnings. Tech stocks, having been down 33% last year, could be a bargain right now to invest in, but only if they have strong earnings. That's where you're going to see the rebound, is when their earnings are strong and they surprise us on the upside. One of the best performing fund managers of all time, Peter Lynch of Fidelity, said this: "People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game." And that's so true. We don't get scared out of the game because we expect it's part of the game, and it's already baked into the cake. It's baked into the long-term performance numbers of that 8 to 10% that we quote over the long term. So we have calamitous years that happen from time to time. We've had a couple not that long ago, and we've been able to turn things around. So while it's never fun to have a year like we had last year, and we don't know how 2023 is going to turn out, what I will say is keep the faith. Using times like now to invest new funds if you have them available, or to continue to dollar cost average, like in your 401k plan, is a smart way to invest. A wise investor once said, "Fortunes are made during bear markets, you just don't realize it at the time." And that means you're buying investments on sale. You're buying them at a lower price. If you have the funds available to do that, I think that's a smart thing to do and to average in over time. Buy the dips, stay invested, and continue to add money into your 401k. This is what's going to propel you ahead when markets recover. We don't often know when they're going to recover because markets will anticipate recovery before we actually see it in the numbers. For example, markets usually move up 6 months before the end of a recession. So the market already knows that we're going to be coming out of recession soon, and it starts to move before we see the actual evidence that things are getting better. The markets take all of the information that's out there, and it's all taken into consideration. Things that are known by insiders and things that aren't. It's already all baked into the cake. Rather than try to predict what things are going to happen or try to catch the exact bottom, it's usually smarter to continue to average in over time. So just remember, this too shall pass. We don't know when this bear market will end, but it will end. They always do. And it will go on to be the next bull market. The second year of the decade can often be the low for the entire decade. So sometime either last year or next year, it's likely that we see that bottom and then move on to stronger days ahead and to new all-time highs. The best thing is to not worry about trying to predict it, but just to participate in it. So keep the faith, be confident, better days are ahead, and somewhere out there, so are new all-time highs. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified of new podcasts as soon as they become available. And if you want more financial tips, go to my website at lindapjones.com and sign up for my weekly email. There's a gold pop-up box on my website. Just put your name and email in there and you'll receive my email every Thursday. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.